Hi, everyone. This is Tony D'Amico with Fidato Wealth. Thanks for joining me for this recorded video webinar. With all the volatility that has occurred with Russia's invasion of Ukraine, I wanted to review some additional research that I received this week. We did release some research that I looked at last week that looked at geopolitical events and how that affects the capital markets. But today I want to review some additional research that I think that you'll find, really helpful. So I'll go ahead and share my screen with you. So as I mentioned, we'll talk about geopolitical events and how that could impact your portfolio. We'll talk about exposure to Russia in our clients' portfolios, and we'll also discuss Fidato's rules-based approach or our investment management philosophy. Okay, so this is research that was released just this week by Vanguard, very similar to the research that I emailed out last week from other sources. So it looked at, about 8 different geopolitical events that have occurred and kind of how the markets reacted. So you can see here that there's always an initial sell-off. So that's this gold bar. This light green bar shows you returns 6 months later, and then the darker green is returns 1 year later. So you can see here that there's always an initial sell-off, and that length of time varies. And if you look at these different geopolitical events, there was other some pretty substantial events that have occurred. You could see the Cuban Missile Crisis, Nixon's impeachment proceedings, the Iranian hostage crisis, the Soviet invasion of Afghanistan, the Iraq War, the Arab Spring, the Ukraine conflict that happened in 2014, and then the Brexit, right? So you can see in all these scenarios, obviously there's an initial sell-off, but 6 months later, in all but really one case where the market's up. So you can see, with President Nixon's impeachment, that markets were down. So the average total return after 6 months from the event is a 5% average total return. 1 year later, the average total return is 9%. And again, in all cases but one of them was, the S&P 500 was up after that. So very important. There is no data out there. There's nothing that's statistically significant that we could, trade on with any degree of reliability. What markets actually show is that geopolitical events, while they're obviously very, disturbing to us on a personal level, should not affect your portfolio. So that's kind of what this slide here is about. Just should geopolitical events affect your investing strategy? And to recap, geopolitical sell-offs are typically short-lived. The quality of the asset allocation that you have, the quality of the diversification, and the quality of the fund managers are always tested in moments like this. And furthermore, if there's intentionality in your portfolio, if it coincides with your risk profile, and if it supports a comprehensive long-term financial plan, those are also important boxes to check. With that being in place, you should really stay the course. I had a chance to listen to Vanguard's CEO earlier this week, and he said something that I've been saying lately. He said, I've been doing this for 30 years, and I've never met anyone that can know when to both get out of the market and know when to get back in. It's virtually impossible. And with my 20-year history in personal finance, I could share with you the same thing. I haven't met anyone that benefited by making an emotional decision or trying to time the market. Let's look at Russia exposure in your portfolio. I think this is really important. We use Dimensional Fund Advisors for their emerging markets fund, a very highly rated fund. It is a small piece of our client's portfolio, a very small piece. It's in there for diversification purposes. So it's important to note that as of January 31st, 2022, Russian stocks held, was basically 0.92% of that fund, while an emerging markets index fund that can't be more selective like Dimensional can, an index fund holds 3.32% in Russian securities. So that's a substantial difference. So, a very, very, really big difference. And that's been the case with Dimensional since 2014 when Russia annexed Crimea. Okay. Furthermore, Dimensional does not buy locally listed Russian securities, but they get exposure through depository receipts purchased on exchanges, those two exchanges. So these depository receipts that they buy offer certain investor protections and liquidity benefits. So again, very important, again, to note. All right, so let's kind of move on here to the next topic. And in January of 2022, Dimensional halted further purchases of Russian stocks in response to the rising risks of sanctions on Russia from the United States and other countries. So that's very important. So again, this shows you I think a benefit. It's a huge benefit of having an institutional manager for these different funds that are watching things on a daily basis, right? So very important. They're also going to continue to evaluate the suitability of Russian securities for their portfolio. Additionally, Russian denominated bonds are not eligible in Dimensional's fixed income or their bond portfolios. So very important to note. And also, just to put this into context, the emerging markets fund that we hold in our portfolio, again, it's an important diversifier. Is it going to do great now? No, of course not. Does it mean that we abandon the strategy? No, of course not. So if we have a client that's in our moderate portfolio, which is 60% stocks, 40% bonds, their exposure to the Dimensional emerging markets core fund is 3.6%. And again, we use that fund because it has a phenomenal track record. Okay. It's important to note that at Fidato Wealth, we use institutional managers for certain areas of the market. We don't just use index funds or exchange traded funds. We do for some areas of the market, but not for all. There's areas of the market like emerging markets, international, the bond market, value stocks, that having an institutional manager that's monitoring things on a daily basis is very critical. So that's why we use an institutional manager here. So that way they can employ a flexible process and they're not beholden to an index. So when you have just an index fund, they basically have to mirror the index. They can't have these additional criteria like Dimensional does. So yeah, very important to note that while we're looking at the total portfolio, we're doing our constant evaluations of the portfolio economic conditions. I obviously do investment manager due diligence on an ongoing basis. The institutional managers that we use also are managing things and monitoring things daily. So these things have been in place, since January, which I think should be hopefully enlightening and comforting to know. All right. So let's look at our investment philosophy and, the the way that I want to explain this is we have to take a rules-based approach to investing capital, right? So we have to have a philosophy that we stick to when there's when times are going really well. We don't want to chase the markets, and when there's volatility in the markets, right, we need to take advantage of that, right, and remain disciplined. So we have to have what I call a rules-based approach. So number one is, our goal is to educate all of our clients. I think that's really important for our clients to have a high level understanding of the markets and understand things. So we want to educate our clients so that way they avoid at all costs the common investing and financial mistakes that have been identified in the field of behavioral finance. So the human brain and the human mind and our behaviors are tied towards the fight or flight response. So we're not naturally geared well to keep money invested, right? You've probably heard me review with you in other webinars that unfortunately about 95% of people in America tend to buy high and sell low. And that's not ideal. So you probably heard me say that investments often do much better than investors. So we want to really educate our clients so they understand high level what's happening. I think that's really important. Overall, we take a long-term evidence-based approach. So I think that's also really important. We looked at, when we put together our investment philosophy years and years ago, we looked at the long-term data. What is statistically significant out there with returns? So we looked at that. We also looked at, you guys have seen my presentation on elections and is there anything that we can glean from elections or midterms? Now I've showed you more research on geopolitical events and epidemics. So we study how the market reacts to these events and if there's anything that's reliable that could be traded on. And really the most reliable thing that can be traded on is, again, utilizing that long-term data on asset classes. Again, we know stocks are going to outperform bonds. We know within stocks, small caps outperform large caps. We know value stocks outperform growth stocks over time. We know profitable companies outperform less profitable companies over time. So these are things that are baked into your total allocation to come up with a strategic tilt towards asset classes that have a better return and standard deviation relationship, which is basically a measure of variation of the returns, right? So we want to tilt towards those more favorable asset classes and tilt away from asset classes that have less favorable returns and level of variation of the returns, right? So obviously that's really paramount. Again, how do you invest unless you're utilizing something where there's been historical evidence, there's been data that's statistically significant? Another important thing is that we prescribe to is that asset allocation is the primary determinant of returns. So if you're a long-term investor and you have a better return than maybe somebody else, it's basically going to be because perhaps you had more stock exposure, or maybe you had more small cap exposure. It all comes down to what asset classes you're in. That is the primary determinant of returns, and there's a lot of research to validate that. Obviously, coming up with an asset allocation for a client is something that takes a lot of time, thought, discussion, and having a asset allocation that supports a long-term financial plan. So diversification is also another really big thing. So you diversify not because of what you expect, because of what you don't expect. So our portfolios have 14 different positions in there at the moment. And that's really important. When there's volatility like this, when we meet with prospective clients, a lot of times we're seeing kind of a portfolio that maybe has 7 positions in there. And that really doesn't cut it. That's more of a cookie cutter kind of portfolio. So the level and depth of your diversification and asset allocation really matters, right? And again, why do you diversify? While some things are doing well, others will not be. And that's what we want, right? So just like how when there was that volatility with COVID in the spring of 2020, bonds held their value, right? So that's what we want. Some of those 14 positions will hopefully be up or neutral, while others might be down. That's really important. And what does that do? That creates opportunities, one, for distributions, right? You experience a gain when you sell. So we want positions to be up so we can select those positions to sell to either fund distributions, or conversely, if you're making contributions to your portfolio, then obviously we want to buy the positions that are down. So we expect volatility. So volatility is expected both to the downside and upside. We know how often declines typically happen. We know the average length to recovery. So this is important. So volatility is expected and needs to be embraced, right? I wish the markets only went up. And so it's important to note that, right? It's too costly to try to time the markets. The best days in the market often occur right after the worst days. And those returns are very concentrated, meaning that if you just missed those, there's one kind of study we review with clients as part of our onboarding process, but it looks at the last 20 years. And if you just missed the 10 best days, which typically occur within a couple of weeks of the worst days, if you miss those 10 best days, it cuts your overall return in half over that 20-year period. So returns are very concentrated. And so it is way too costly to try to time the markets. Again, I have never run into anyone that was perhaps coerced or influenced to try to get into some sort of strategy that maybe was going to try to time the market or offer better, kind of a return that is in excess of the level of risk. I've never seen anybody be successful doing that. I've never heard anybody say, "Oh, geez, I'm glad I did that." Hasn't happened. So I talked a little bit about threshold-based rebalancing. Again, so we will continue to employ that as we have for years and years. And what that is a systematic way to sell high and buy low. So as positions drift in and out of band, we're going to take advantage of that. So each position has a target allocation. It also has a high band and a low band. Once the high band is crossed, when we rebalance, it'll sell those positions and it'll buy the other positions in the portfolio that have decreased below the low point of that target range. So very important. Again, it's what we did through the COVID volatility. Stocks had dropped significantly. We rebalanced client accounts. It, for the most part, sold off bonds that were doing well. It bought the stock funds that were lower in price at the time. Our clients accumulated more shares and they lowered down their average share cost, right? So what is the value of the account? It's the number of shares times your average share cost equals the value of that position, right? So that's obviously what we want to do. It sounds simple, but it requires us to be resolute and follow this process, especially when there's times of volatility. Number 9 is ongoing institutional manager due diligence. So I just reviewed some due diligence that I completed with Dimensional Funds. So that's really important. And I mentioned this already, but investments are part of a comprehensive financial plan where the client is comfortable with their probability of success. They made a strategic decision on how much risk they want to take. Sometimes clients don't need a a double-digit return to fund their financial plan and make it successful, right? That's a red flag if you need a really high rate of return, and our clients aren't in that position. So, that's why we put together a financial plan for our clients that includes their investment allocation. It shows a probability of success. It looks at 1,000 different trial runs of various market returns across a kind of a standard bell curve of probable outcomes, and it issues that probability of success. So that's really important. Additionally, one of the things, and this might be a reminder for our newer clients, before we finalize an asset allocation, we look at that recession stress test within the financial planning software to look at how your portfolio might decline if there was another recession like an 08, 09. So these are really important things. You don't want to, our job isn't to, I guess, predict the rain. It's to build an ark or provide layers of protection. So that's, another important note. Number 11 is to take an opportunistic approach. Again, we need to take advantage of volatility either to the upside or downside. Most of our clients know this, especially the ones that have been with us for 10 plus years. We have a playbook for both investment management and wealth management, meaning financial planning, for when there are either market declines or market increases. The playbook is different, but we know what those opportunities are. We have an internal playbook, and we execute that with our clients that are looking to take advantage of market conditions. The focus on wealth planning. I was explaining to a newer client just this past week, some years you're going to gain wealth through investments. Some years you're going to gain wealth through wealth planning. It could be tax planning or other things that can add to your bottom line. So that's very important. Number 13, one of my favorite Warren Buffett quotes: be fearful when others are greedy, and be greedy when others are fearful. So that is very important. You have to go against your emotions at times. You have to keep your personal emotions, in this example, your personal emotions about the Ukraine conflict outside of financial decisions. So that's very important. Number 14, another part of our philosophy is that fiduciary alignment. Because we're fee-based, none of the funds we use give us any compensation whatsoever. So the better our clients do, the better we do. And that alignment too, I think I have in here additionally, we eat our own cooking, meaning that we use the same investments for our 401k for our employees, or if our employees, including myself, have additional investments outside of a 401k, perhaps an IRA or whatever it might be, we use the same portfolios that we use for our clients. Number 15, and the last one, is really just relentless, unwavering discipline. And so discipline and process, so very important. So in conclusion, keep in mind all that you have in place with your comprehensive financial plan. I think that's, really important. There's a lot that was done with a lot of intentionality, a lot of planning, hours and hours of planning to ensure a comprehensive financial plan and the right asset allocation for your plan. So just kind of keep that in mind. I think that's really important. Be aware of your emotions in regards to your finances. I think that's critical. I've talked about that through this webinar. Emotional awareness and emotional intelligence, I think, are really paramount at this point in time. Avoid at all costs anything associated with the term "this time it will be different." So that's another. Whenever I hear someone say that, I'm like, "Uh-oh, let's have a conversation and try to understand your concerns." But again, I haven't met anyone that made a decision with their finances, and their reason is they felt this time will be different, and were successful. I've never found that person. I haven't. And again, there's no data to show that people can time the market, get in and out of the market, right? If there was, there would be a lot of people doing that. So there just isn't. Do not look at your portfolio regularly. I mean, obviously you can if you want to, but we're monitoring the markets, the portfolios, and economic conditions daily. That's what we do for our clients, and we're happy to. So that's, you know, my recommendation to you. And I think most importantly is to take opportunistic planning actions that are in your best interests, right? Now, that is the one constant that I have seen in my 20 years in personal finances. Those that remain disciplined, but being disciplined doesn't mean doing anything. There are things that can be done. There are things that we do, such as rebalancing, again, monitoring the investments, changing, you know, a manager when needed. That doesn't happen that often, but we do look at that on a regular basis and don't see any need to do any investment changes at the time. But there's other planning actions. It could be tax planning, risk protection planning. Sometimes there's charitable opportunities that come up, you know, during different times of volatility or surprises to the upside or what have you. So is to take those opportunistic planning actions. So, you know, we view that we have a partnership with our clients, a collaboration. So I just want to encourage you too, if you have questions, if you're wondering about what you might be able to do to take advantage of the situation, or if you have a concern, that's okay. We're here for you. And, you know, please reach out to your advisory team. So thanks for joining me again for this video. I hope you found the information really helpful. And again, we're honored to be of service to you. And if you have questions, again, please reach out. So thanks and have a great day. Bye-bye.